Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at supermicrocomputer.
If you find our talks useful, please consider subscribe, like, and comment underneath, well, wherever you happen to be listening. So I want you to imagine something for a second. Imagine a company that's projecting $36 billion in revenue, growing at an eye-watering, 64% year over year?
Yeah, 64%. It's massive.
Right. And they effectively hold a monopoly on the most critical hardware infrastructure in the entire artificial intelligence boom.
Exactly.
But then you wake up to find Wall Street is treating that exact same company like it's literally filing for bankruptcy. Because on March 21st, 2026, Supermicrocomputer lost a third of its entire value in just a matter of hours.
It was brutal. I mean, cratering down to $20.53 a share.
$20.53. So if you're looking at your portfolio right now, you're probably thinking, why would I even consider catching a falling knife when the Department of Justice is actively investigating them?
Right, which is the natural reaction.
Yeah. So today, our mission is to figure out if this massive 33% gap down is just a toxic trap, or if it's actually a deeply discounted value play that, you'll look back on in 5 years and wish you had bought.
Well, to do that, we really have to start by completely separating the raw emotion of that trading session from the actual physical mechanics of the business.
Right, because emotion drives the market in the short term.
Exactly. I mean, a 33% single-day drop on massive volume, that's what we call a capitulation event. But, it didn't just happen in a vacuum.
No, there was a very specific catalyst.
Yeah, it was triggered by a DOJ indictment. They accused a co-founder of the company of smuggling restricted NVIDIA chips to China.
Which instantly taps into, the absolute biggest geopolitical pressure point in the market right now.
Oh, without a doubt. The U.S.-China tech friction.
Yeah, and just impartially speaking here, the U.S. government has extremely strict export controls on these high-end AI chips. So allegations that a founder bypassed those controls to funnel tech overseas, I mean, that's not just a minor regulatory fine we're talking about.
No, it's an existential legal risk.
Right.
And, when a headline like that drops, the selling isn't just driven by human panic. There's this entirely automated structural mechanism that kicks in.
Oh, you're talking about the index risk.
Exactly. The compounding risk here is removal from the S&P 500 index.
Walk us through how that actually works, because I think people hear index and just think of a benchmark.
Sure. So when a company is suddenly engulfed in a federal scandal of this magnitude, the index providers immediately review its inclusion status. And here is where the mechanics of institutional selling just completely take over.
Because of the passive funds.
Right. Think about the trillions, literally trillions of dollars parked in passive index funds and ETFs that just blindly track the S&P 500. If Supermicro gets booted from that index, those fund managers, they don't get to hold a meeting to discuss the company's long-term revenue potential.
They don't care about the balance sheet or the product line at all at that point.
They legally can't care. They are obligated by their fund prospectuses to mirror the index. So if the stock is removed, they must sell their shares, regardless of the price.
Wow.
It triggers this forced, self-fulfilling downward spiral. The fear of index removal causes the initial price drop.
Which then triggers algorithmic stop losses.
Exactly, which drives the price down even further, creating even more panic among retail investors.
Okay, but I'm stuck here, though. You're telling me we have a DOJ smuggling indictment, severe geopolitical headwinds, and the looming threat of trillions of dollars in passive funds being legally forced to dump the stock.
It sounds bad.
It sounds terrible. My gut says, do not touch this with a 10-foot pole. It sounds like a sinking ship, not a fire sale. So why shouldn't a retail investor just run for the hills right now?
Well, if you zoom in on the actual legal filings from that specific day, there is a crucial nuance that the panic sellers completely missed in their rush to the exits.
Okay, what do they miss?
The company itself was not named as a defendant in the indictment.
Wait, let me make sure I'm absorbing that correctly. The co-founder was indicted as an individual, but Supermicrocomputer, the corporate entity, was entirely left out of the charging documents.
Yes, entirely left out. And from a financial liability standpoint, that distinction is the entire ballgame.
Because it separates the person from the business.
Exactly. It legally separates the actions of an individual bad actor from the ongoing enterprise. The market traded on the headline, basically pricing the stock as if the federal government was shutting down the whole corporation.
I see.
But contrarian analysts, the ones who actually sat down and read the document, realized the corporate entity remains intact and fully operational.
That is a massive blind spot for the algorithms and the headline traders. But, I mean, a legal distinction doesn't magically fix a shattered reputation, right?
No, it definitely doesn't.
Because institutional investors despise uncertainty. Even if the company isn't in the direct legal crosshairs, they have a massive trust deficit with Wall Street right now and with their own customers. So how do they even begin to salvage that?
Well, they have to aggressively ring-fence the corporation from the indicted individual, and we're actually already seeing structural governance stabilization taking place.
How are they doing?
They recently brought in BDO as their new independent auditor.
Okay.
Yeah, specifically to comb through past governance issues and ensure their financial reporting is absolutely ironclad moving forward. And on top of that, they named Deanna Luna as the acting chief compliance officer.
So they're essentially bringing in the heavy hitters to clean the house and signal to the market that, the adults are back in the room.
It's a required signal, really, for their major clients. And this dynamic creates what we call a max pain bottom.
Explain that for the listener.
So when a stock crashes 33% on staggering volume, it indicates that the weak hands, so momentum traders, short-term holders, anyone easily spooked, they've been entirely flushed out of the system.
Everyone who wanted out is already out.
Exactly. The selling pressure is physically exhausted. So if the company successfully distances itself from the bad actors, that $20.53 mark becomes a cleared-out foundation.
Okay, so let's assume they navigate the legal storm. The auditor signs off, the new compliance officer tightens the ship, and they survive.
Right.
We still need to know what the underlying machine is actually producing to justify putting your hard-earned money into it.
Right.
Because the divergence between the legal headlines and the underlying fundamentals here seems, well, completely unhinged. If they're surviving, what are they actually selling to make money?
Let's look at the actual business metrics because they are staggering. Supermicro is currently projecting $36 billion in revenue for fiscal 2026.
$36 billion.
Yes. That represents a 64% year-over-year growth rate. And these aren't just optimistic pie-in-the-sky forecasts. They have over $13 billion in secured orders, specifically for the new Blackwell platform.
Okay, let's define Blackwell for a second so everyone is on the same page. That's NVIDIA's next-generation artificial intelligence chip architecture. Right?
Yeah, it's the most anticipated hardware release in the tech sector right now. And securing $13 billion in orders for it highlights Supermicro's distinct technological moat.
Which is what, exactly?
They dominate the market for liquid cooling solutions in data centers.
Okay. We really need to unpack the mechanics of why liquid cooling is such a big deal, because I think a lot of people completely misunderstand this.
Yeah, they do.
For a long time, the go-to analogy in wealth building has been, selling picks and shovels during the gold rush.
Yeah.
But I feel like that metaphor is completely played out and doesn't actually explain the technology.
It really does.
Let's look at this more like building a high-performance sports car. The tech giants, the hyperscalers, are buying the biggest, most aggressive engines on the planet, which are NVIDIA's Blackwell chips.
Right.
But if you drop a hypercar engine into a chassis without a massive, highly specialized radiator, that engine is going to melt into a puddle of slag before you even get out of the driveway.
That is a perfect analogy. The thermal dynamics of a modern AI data center make that radiator analogy painfully real.
Because they run so hot.
Unbelievably hot. Traditional air cooling, giant fans blowing cold air down server aisles, that has hit its physical limit. These next-generation AI clusters draw over 100 kilowatts of power per rack.
Wow, 100 kilowatts.
Yeah. They run so incredibly hot that air simply cannot dissipate the heat fast enough anymore. So direct-to-chip liquid cooling is no longer just some luxury upgrade. It is a mandatory physical requirement to keep these data centers from literally catching fire.
And Supermicro controls that.
They command an estimated 70 to 80% market share in data center liquid cooling. 70 to 80%. So if you are a major cloud provider, you might be furious about these DOJ headlines. You might want to punish them.
Sure.
But you literally cannot afford to stop buying from them because they're the only ones who can provide the radiator for your multi-billion-dollar AI engine at that kind of scale.
Exactly. It all comes down to switching costs. Now, the bear argument here is that hyperscalers will pause their orders to audit Supermicro's supply chain compliance.
Which makes sense.
It's a completely valid risk. However, because they control up to 80% of the liquid cooling market, hyperscalers have almost no viable alternatives in the short term. Moving away from Supermicro means delaying their own AI infrastructure rollout by months, maybe even years, which they cannot afford in the current AI arms race.
Not at all. The high switching costs fundamentally protect the order book.
I hear that, but let's not paint this as a flawless business model. Even before the legal drama, Wall Street was punishing this stock because of a severe margin squeeze.
Yes, that's true.
They used to target gross margins of around, 14 to 17%? But recently, those margins have compressed down to an estimated 9 to 11%. So they're making noticeably less profit on every rack they sell. What's driving that compression?
They are engaged in a very aggressive price war. Legacy hardware competitors like Dell and Hewlett-Packard Enterprise are desperately trying to encroach on their liquid cooling market share.
So they're dropping prices to fight them off.
Exactly. To defend their territory, Supermicro has adopted a deliberate volume-led strategy. They are knowingly accepting lower profit margins to win massive enterprise contracts and lock in those customers.
It's the classic tech strategy, right? Capture the monopoly first and worry about squeezing out extra percentage points of profit later.
Exactly.
But how do they survive that margin compression without just bleeding cash? I mean, if they're dropping prices to beat Dell, how does the math still work internally?
They rely on sheer economies of scale, facilitated by a manufacturing architecture they call building block solutions.
Building block solutions. What does that mean in practice?
So instead of designing entirely custom servers from scratch for every single client, which is incredibly slow and expensive, they engineer their server components as standardized modular blocks.
Oh, like Legos.
Think of it exactly like high-end Legos. They can snap together different combinations of power supplies, motherboards, and liquid cooling manifolds to rapidly customize servers for specific clients.
And that's faster than Dell.
Much faster and cheaper than Dell or HPE. This modularity drastically reduces their engineering costs and time to market. That's what allows them to remain profitable even when they slash their retail prices to win a major contract.
So the margin drop isn't necessarily a sign of a failing business. It's more like a strategic weapon they're using to maintain that 70 to 80% dominance against massive legacy competitors.
Precisely. And when you connect that volume-led strategy to the current share price, the valuation metrics become deeply compelling for a value investor.
Let's talk numbers then.
At $20.53, the stock is trading at a 63% discount to its own 3-year average.
A 63% discount, that's huge.
It is. It currently sits at a forward price-to-earnings ratio of just 6.9x.
Let's just pause right there and put that number in perspective for you listening. A forward PE of 6.9 basically means you're paying less than $7 for every dollar of future earnings the company generates.
Right.
Usually, a massive tech company growing revenue at 64% trades at a multiple of 30, 40, or even 50 times earnings. You only see a multiple of 6 on a dying legacy business like, I don't know, a coal mine. Not a company selling the physical backbone of the artificial intelligence revolution.
It is a striking anomaly in the current market. And furthermore, it trades at just 16 times free cash flow.
Which proves what?
This metric proves that despite the margin squeeze we talked about, the underlying business is highly efficient at generating actual spendable cash relative to its depressed valuation. They maintain a moderately strong balance sheet, which is vital right now because they need massive working capital to physically manufacture the hardware for that $13 billion Blackwell backlog.
So if we synthesize all these moving parts, the geopolitical legal risk, the very real threat of index removal, the 64% hypergrowth, and this absurdly low valuation, where does the risk versus reward actually land for you as an investor?
Based on the data, this scenario yields a bullish score of 7 out of 10.
Okay, a 7.
But, and this is crucial, it carries a massive high-risk, high-reward asterisk. The threat of S&P 500 removal is a sword hanging over the stock, and short-term customer pauses could still happen.
Yeah, we can't ignore that.
However, the reward side of the equation is grounded in hard, undeniable fundamentals. The business has a solid floor established by its massive cash flow, its $36 billion revenue run rate, and its virtual monopoly in mandatory cooling tech.
So for you listening to this right now, the actionable takeaway is to frame this as an opportunistic value play. But you need a strict 6 to 12-month horizon.
Definitely.
If you enter this position, you have to have the psychological stomach for extreme volatility. The legal process is going to drag out, and the headlines will undoubtedly be ugly. The wealth-building thesis here is that you're accumulating shares during a period of maximum irrational panic.
You're betting that the broader market will eventually wake up and recognize the legal separation between the indicted co-founder and the highly profitable corporate machine.
And as that realization sets in, the valuation should violently revert toward its historical mean.
Exactly. But to navigate this kind of volatility, you really need a roadmap. Let's look at the catalyst calendar for the next 3 months to see exactly what to watch for.
All right, what should investors be looking out for in the immediate future? Let's say the next 2 weeks.
The single most critical catalyst over the next 2 weeks is official clarification of liability from the Department of Justice. If the DOJ publicly reaffirms or makes it explicitly clear in a legal filing that the corporate entity is not a target of the investigation, that removes the existential dread from the market.
And what happens to the stock if they do that?
If that happens, we could see a violent snapback rally driven by short covering.
Let's explain short covering quickly for anyone unfamiliar. That is when traders who bet against the stock by borrowing and selling shares are suddenly forced to buy the stock back to cover their positions when the price starts rising.
Right.
And that flood of forced buying acts like rocket fuel, shooting the share price straight up.
That mechanism is exactly what triggers a mean reversion rally. Now, moving into the near term, so the next month or two, you need to monitor Deanna Luna, the new acting chief compliance officer.
What are we looking for from her?
The market expects her to outline a comprehensive framework of enhanced internal controls. Hyperscalers need to see that compliance framework in black and white before they feel politically safe signing the next massive purchase order.
Makes total sense. And then finally, we have the upcoming earnings call.
Yes. The earnings call will be the ultimate reality check. Wall Street analysts will be laser-focused on one thing. Is the core business fundamentally intact?
So management needs to confirm that the $36 billion revenue run rate is still happening.
Exactly, and that those $13 billion in Blackwell orders have not been canceled. If they confirm that the fundamentals are completely unchanged, a 6.9 forward PE ratio will become mathematically impossible for institutional value funds to ignore.
This has been a fascinating breakdown. We started with what looked like a completely radioactive asset, a stock crashing 33% on a federal smuggling indictment, and we've unpacked the mechanics to reveal a cash-generating AI infrastructure giant trading at a generational discount.
It really illustrates why looking past the headlines to understand the structural mechanics of a sell-off is so vital.
Absolutely.
The distinction between a corporate indictment and an individual indictment might seem like boring legal semantics to some, but in the wealth-building landscape, it is the difference between total capital destruction and a rare buying opportunity.
No doubt about it. And as we wrap up today's stock analysis, I will leave you with one final forward-looking thought to chew on. We've established that this company essentially holds a monopoly on the mandatory liquid cooling technology needed for the AI revolution.
Right.
And right now, their market cap has been brutally slashed by this panic selling. This raises a very speculative but highly important question. At this massive 60% discount, does Supermicro become a prime M&A takeover target?
Oh, that's an interesting thought.
Right. Would a larger hardware giant, maybe one of those legacy competitors like Dell or HPE, who are struggling to catch up in the liquid cooling space, decide it's much cheaper to just buy out Supermicro at a $20 share price than to spend years trying to engineer competing technology?
In the high-stakes world of AI infrastructure, a beaten-down giant with an impenetrable technological moat is a very tempting prize.
Something for you to keep a close eye on as the dust settles.